Chapter 10, Valuation Principles. Learning Objectives. After studying this chapter, you should know about need for business valuations and sources of value in a business. Various approaches to valuation. Different types of business valuation models. Objectivity of valuations and important considerations in business valuation. Difference between price and value. Mr. Seth Klarman, a known value investor, stated, "In capital markets, price is set by the most panicked seller. Value, which is determined by cash flows and assets, is not." This is both the challenge and the opportunity of investing, to carefully sift through the markets to find the greatest divergence between price and value and to concurrently avoid the extreme emotions of the crowd and, indeed, to take a stand against them. Warren Buffett is also known to state frequently, "Price is what you pay and value is what you get." Price and value are two different concepts in investing. While price is available from the stock market and known to all, value is based on the evaluation and analysis of the valuer at a point in time. There is no formula or method to throw a precise number on valuation of an asset. There are uncertainties associated with the inputs that go into the valuation process. As a result, the final output can at best be considered an educated estimate, provided adequate due diligence associated with valuing the asset has been complied with. That is the reason valuation is often considered an art as well as a science. It requires the combination of knowledge, experience, and professional judgment in arriving at a fair valuation of any asset. Why valuations are required? While purpose of carrying out valuation could vary from person to person, some of the reasons for carrying out valuations of assets/businesses/liabilities are as follows. Buying a business as part of investment exercise. Selling a business as part of investment exercise. Mergers and acquisitions. General sense of value of business to owners. Fair treatment to different set of stakeholders in case of equity swap. Accounting, taxation, and other regulatory and legal requirements. Whatever may be the objective of valuation, the purpose of valuation is to relate price to value and estimate if it is fairly priced, overpriced, or underpriced. Given the limitations in the valuation process, valuers typically present multiple scenarios that reflect the effect of a change in the primary variables on the output value. Sources of value in a business: earnings and assets. Warren Buffett stated, "There are only two sources of value in a business: earnings and assets. Any asset, whether a financial asset such as a stock or a bond, or a real asset, generates two streams of cash flows: periodic earnings and a final inflow on sale of the asset. In case of bonds, coupons produce earnings and redemption/sale of bond in the market produces one-time cash flow. Equities also produce earnings in the form of dividends and then one-time cash flows on sale. Real estate provides rental income and an appreciated capital value on sale. Businesses are established for the same reason, to generate cash flows in the form of earnings and the potential to realize cash flows from the sale of tangible and intangible assets if earnings are not sufficient or they die down, and owners proceed to collect their money from liquidation of business/assets. Interestingly, lenders also think the same way. Lender will first ensure that the business will be able to generate the cash flows to meet its obligations before making the lending. The collateral offered is not the primary consideration in their decision-making, and it is only a fallback mechanism to recover their money if their cash flow estimates prove wrong. They want borrowers to pay from their cash inflow streams. It is also important to note that the capability of the business assets to pay up all liabilities and settle the equity holders is always doubtful. Assets may be worth a lot less than what they appear for in the balance sheet, but the outstanding liabilities have to be settled in full. Approaches to valuation. Asset valuation can be broadly classified into three categories. 1. Cost-based valuation. Under this approach, an asset is valued based on the cost that needs to be incurred to create it. This option is suitable only for a buyer who has the choice between buying versus making. Most investors in the stock market typically do not have the choice to build and run a company on their own. Hence, this approach is generally not suitable for financial investors. However, strategic investors who intend to carry on the business into the long term may consider using this approach. 2. Cash flow-based valuation, intrinsic valuation. Intrinsic valuation approach assigns value to an asset based on what an investor would be willing to pay for the cash flow generated by the asset. This approach typically involves valuing an asset by discounting its cash flow at a suitable rate that reflects the rate of return expected by an investor. Intrinsic valuation can be divided into two categories. A. Risk-neutral valuation. It involves adjusting the cash flows by the probability of realizing the cash flow. It is then discounted at the risk-free rate. Insurance companies are typically valued using this approach: embedded value and appraisal value. B. Real-world valuation. It involves estimating the most likely cash flow and discounting it at a rate of return that reflects the risk-free rate plus a suitable risk premium to account for the uncertainty in the cash flows. 3. Selling price-based approach, relative valuation. Under this approach, an asset is valued based on the price of other similar assets. Various valuation ratios such as P, PB, EV upon EBITDA can be used as the valuation metric. Cost-based valuation often involves technical assessment by engineers and is seldom employed by financial investors. Hence, we shall discuss the other two techniques. Discounted cash flows model for business valuation. Consider a bond on offering which generates 9% as interest per annum and gets redeemed at the end of 10th year on its face value of 100,000 rupees. Current prevailing interest rates or expected return by investors in the economy are also 9% for this maturity and credit quality. What would be the value of this bond today? The value of the bond is the present value of all the future cash flows discounted at the prevailing interest rate of 9%. As both coupon and expected rate, discount rate are same, it would turn out to be face value vis 100,000 rupees. If expected rate of return by investors is higher, lower than 9%, then the bond would have value less, more than 100,000 rupees. It is simple mathematics based on present and future value computations. Readers are advised to revise basics of present and future value computations before going ahead on this chapter. This is an example of discounted cash flow model for bond valuation. Actually, every asset or liability is priced the same way. Assets are acquired at a cost, and the expectation is for these assets to generate a combination of earnings and/or capital gains on sale of assets. If the bond is replaced with equity, the coupons will be replaced with dividends and redemption value by expected sales proceeds from sale of equity. However, in case of bonds, both quantum of cash flows and their timings were known with certainty. In case of equity, quantum of cash flows, dividends or sales price, and their timings are unknown and uncertain. The concept of valuing an asset based on its cash flows can be extended to valuing businesses based on their earnings, profits, or, to be more precise, cash flows and terminal value, one-time sales proceeds from assets. While the discounted cash flow models are used to value businesses, these valuations come with significant errors of judgment because of the inability to measure quantum and timing of future cash flows with certainty. These models could also be very sensitive to some input factors. Conceptually, discounted cash flow (DCF) approach to valuation is the most appropriate approach for valuations when three things are known with certainty: stream of future cash flows, timings of these cash flows, and expected rate of return by the investors called discount rate. Once these three pieces of information are available, it is simple mathematics to find the present value of these cash flows, which a potential investor in that instrument would be willing to pay today to receive the expected cash flow stream over a period of time. In valuing a business, the cash flows, outflows, and inflows at various stages over its expected life are considered. A rational way to find the value of a business may be to first find the inflows over outflows, called free cash flows (FCFs), at different points in time, and then bringing them to today, find present value (PV) at an appropriate rate of return. Discount rate (DR). This is called discounted cash flow (DCF) method to value a project or a business/firm. The two principal factors that drive the valuation of a firm using DCF are estimating the expected cash flows, and the second is the determination of the rate used to discount these cash flows. The value estimated using the DCF can vary across analysts if there are differences in estimating these two factors. There are three different approaches to DCF models. Dividend discount model (DDM). Under this model, the expected future dividends of a company are discounted based on the cost of capital. This model is suitable for companies that pay regular and substantial dividends. Thus, this model is more suitable for mature companies in the defensive industry. Unlike bonds, equities have perpetual life, theoretically. Further, dividend payments are not contractual in nature. Therefore, DDM involves making certain estimates and assumptions. Gordon Growth Model, also referred as Perpetual Growth Model, provides a way to value a dividend-paying company where the dividend is expected to grow perpetually at a constant rate. For a company with cost of equity K and a dividend that is expected to grow at a constant rate G, the fair value of the shares P of the company would be P equals D1 divided by K minus G, where D1 refers to dividend expected to be received at the end of the year. Free Cash Flow to Equity Model, FCFE. One of the problems in using DDM is that it is not possible to use for companies that do not pay dividends. Even some of the well-performing companies may not pay a substantial dividend as they may want to use it for reinvestment. For instance, Alphabet Incorporated, parent company of Google, has never paid dividend. The FCFE model provides an alternative to dividends. Under this model, equity is valued by discounting the free cash flow to equity shareholders instead of the actual dividends paid by the company. Free cash flow to equity is computed as follows. Operating cash flow minus capital expenditure minus interest payments plus or minus net borrowings or repayments. FCFE models are most likely to be useful for companies that are in high growth phase. However, if a company is in high growth phase, it would be inappropriate to assume a constant growth rate for the cash flows. The growth rate the company may be experiencing is likely to be very high, unsustainable in the long run, and may also be higher than the cost of capital. In such cases, it would be appropriate to value the cash flows of the company in two stages. Value of the equity equals present value of FCFE during high growth phase plus value of perpetual stream of FCFE after high growth phase, referred as terminal value. In order to value the company in two stages, analyst has to assess how long the company is likely to grow at higher rates and then estimate the FCFE for all the time periods in the high growth phase. These cash flows are then discounted. Analysts can then use the Gordon Growth Model to value the perpetual stream of FCFE post-maturity using FCFE in place of dividends. It is to be noted that the terminal value has to be discounted further to its present value. Free Cash Flow to Firm Model, FCFF. One of the major challenges in using the FCFE model is that, unless a company has an objective debt policy, it is not possible to objectively estimate the net borrowings/repayment. If a company does not have a stated policy, the borrowings may have to be estimated using arbitrary considerations. This can lead to significant bias in valuation. Thus, in many such cases, analysts prefer to use FCFF model. FCFF represents the free cash flow before taking into consideration any cash flows pertaining to any source of capital. It is calculated as follows. Operating cash flow minus capital expenditure minus tax benefit on interest payments. Often, analysts may try to calculate the same using the indirect method in which FCFF is calculated as follows. EBIT multiplied by 1 minus tax rate plus depreciation and non-cash charges less decrease in working capital less capital expenditure incurred sale of assets. Apart from depreciation, other non-cash charges include amortization of capital expenses and loss on sale of assets, which are added back. Gains on the sale of assets is deducted from the FCFF and FCFE calculations. Under the FCFF model, the value of the business enterprise value is derived by discounting the FCFF. Since FCFF is the cash flow available to all sources of capital, discount rate is taken as the weighted average cost of capital WACC that factors all sources of capital and investors' expected return on the same. Once the value of business is estimated, the value of equity is then derived by subtracting minority interest, preferred share capital, and debt, and by adding cash, cash equivalents, and short-term investments. Similar to FCFE models, when valuing high-growth companies, FCFF models also involve segregating the valuation into two parts: value of cash flows during high-growth phase and terminal value. This requires a forecast of the cash flows expected in the future. A rudimentary forecast can be derived by extrapolating historical growth rates experienced by the company. However, analysts often use their judgment to refine their forecast by taking into consideration several factors, including the internal determinants of growth, namely, the proportion of earnings plowed back into the business and the return on equity that it is expected to earn. The terminal value is often valued using the perpetual growth model. The perpetual growth rate is often capped at the long-term nominal GDP growth rate of the markets in which the company operates, as it is not possible for a business to grow faster than the economy till perpetuity. However, analysts may consider using a lower perpetual growth rate if that appears appropriate in their assessment. Alternatively, terminal value can also be calculated by taking into consideration the expected sale value of the business at the end of high-growth phase. This is typically done by multiplying EBITDA or EBIT at the end of the high-growth period by the appropriate EV upon EBITDA or EV upon EBIT multiple. The multiple is decided based on that of comparable firms. The terminal value is added to the cash flows for the growth or projection period and then discounted to the present value. The discount rate used in the DCF valuation should reflect the risks involved in the cash flows and therefore the expectations of the investors. To calculate the value of the firm, the FCFF is discounted by the weighted average cost of capital WACC that considers both debt and equity. To calculate the value of equity, FCFE is discounted using the cost of equity. In most of the valuation exercises, cost of debt is taken as the prevailing interest rates in the economy for borrowers with comparable credit quality. And cost of equity is the rate of return on investment that is required by the company's common shareholders. Capital Asset Pricing Model CAPM, which establishes the relationship between risk and expected return, forms the basis for cost of equity. It has three components. The risk-free rate of return RF, a return that reflects the return expected on a stock market portfolio RM, and a return that compensates for the business and financial risks specific to the stock of the company itself. Known as the company's beta. Beta of a stock measures the change in the stock prices vis-a-vis change in the benchmark index/stock market. Given the above understanding, cost of equity is generally computed with the help of Capital Asset Pricing Model CAPM, which defines cost of equity as follows. KE equals RF plus beta multiplied by RM minus RF, where RF is the risk-free rate, RM minus RF is the market risk premium MRP, and beta is the measure of stock's volatility. The weighted average cost of capital of the firm WACC is then calculated as under. WACC equals KE multiplied by equity divided by equity plus debt, plus KD multiplied by 1 minus tax multiplied by debt divided by equity plus debt, equals KE times WE plus KD times 1 minus tax times WD, where KD is the cost of debt, WD is the weight of debt, KE is the cost of equity, WE is the weight of equity. The free cash flows are then discounted at the appropriate discount rate to arrive at the enterprise value, EV, of the firm or the value of equity, as the case may be. DCF valuations may result in erroneous output if sufficient rigor does not go into estimating the cash flows and discount rate. Relative valuation. As seen above, DCF method throws up a number on valuation based on stream of cash flows, their expected timings, and a discount rate. It is a complicated method given the assumptions which go into estimation of future cash flows. Valuation exercise is undertaken to compare the price with value to arrive at whether a business is overpriced, underpriced, or fairly priced by the market. This helps analysts make their recommendation: buy, sell, or hold. Instead of finding absolute valuation of business, we may like to compare what we get with what we pay to arrive at a sense of valuation. What we pay is the price, and what we get is the earnings and assets of the business. Therefore, if we can compare price with earnings and assets, we can get a sense of valuation, not the absolute valuation, but whether something is cheap or expensive. Earnings-based valuation matrices. Dividend yield, price to dividend ratio. Dividends are the profits that the company pays out to its equity holders. Well-managed companies maintain a stable dividend payout to their investors even while ensuring that the growth prospects of the company are adequately funded by plowing back a portion of the profits. Dividends can be compared with the share price for a sense on cheapness or expensiveness of equities. Popularly known term on this subject is dividend yield, which is defined as dividend yield equals dividend per share DPS divided by current price of stock. Consider a company with a history of paying dividend of 5 rupees or more over the last 5 years, including the last dividend. At different price points, the dividend received translates into the following multiples. We may look at this business at different price points, ranging from 50 rupees to 200 rupees. When we compare what we get against what we pay at different price points, the results are as follows. It is quite apparent from the above table that at 50 rupees, the business is available at 10% dividend yield and a price-to-dividend ratio of 10 times. The price-to-dividend ratio is a measure of what the market is willing to pay for a rupee of dividend. If the dividend yield is compared with the corresponding bond yield, it looks pretty interesting on a post-tax return on investment basis. If bonds are offering 10% coupon on post-tax basis with 30% tax rate, post-tax return on bonds would be, say, 7%. Here, equity is offering 10% post-tax return, dividends being tax-free in the hands of investors. Also, there is a potential for upside in equity if earnings go up. This upside may not be available in debt, as debt papers would generally get redeemed at their redemption value. At a market price of 200 rupees, the dividend yield is 2.5%. Clearly, it is inferior to the bond yield. Also, the price-to-dividend ratio for 200 rupees is quite high at 40 times. If equity yields are, in general, higher than bond yields, clearly equity is available cheap. This is typically true when markets are down. On the other hand, during bull markets, equity yields are quite lower than the bond yields. A stock available at a dividend yield higher than those of comparative stocks and the market dividend yield may be seen as a value pick. It may not necessarily be so. A high dividend payout may indicate limited avenues for expansion and investment, which in turn may limit capital appreciation. Earning yield price-to-earnings ratio. When dividend yields are quite low, market analysts move to earnings yields a step higher to consider the investment potential in a stock. Earning yield may be defined as earning yield equals earnings per share, EPS, divided by current price of stock. The reciprocal of earning yield is the popularly known price-to-earnings ratio, which can be defined as price-to-earnings ratio equals current price of stock divided by earnings per share, EPS. EPS represents the net profit divided by the number of shares. Generally, only a part of the EPS is distributed as dividend and part is retained by the company for future expansion. The PE ratio indicates the amount of money an investor needs to invest to receive 1 unit of profit. It is calculated using the current market price and the historical EPS or forward PE by using the forecasted EPS. Investors may be willing to pay a higher price for the earnings if they expect above-average growth in the future or the company is expected to make a turnaround in its performance. All else held constant, a stock with higher PE ratio compared to the peer group numbers and the market PE is considered to be expensive stock. Similarly, a stock with a relatively low PE is considered as undervalued stock. However, shares of companies with higher growth potential or lesser risk should trade at a premium to its peer group. Similarly, shares of companies with lower growth potential or higher risk should trade at a discount. Therefore, analysts should also consider these factors while assessing the valuation. Further, companies' earnings are for a particular period, whereas price is at a particular point. Therefore, it is important to ensure that the period of reference for the EPS is appropriate from investors' point of view. Most often, investors assess companies based on their future potential rather than past performance. Therefore, they tend to give higher importance to estimated future earnings as compared to past reported EPS. However, the period of reference for future earnings estimates is somewhat subjective. If investors expect EPS for the ongoing financial year to be unduly low or high, they may intend to compare the stocks based on the expected earnings for the next financial year. Analysts should exercise their judgment in determining the appropriate period of reference for identifying EPS. Growth-adjusted price-to-earnings ratio, PEG ratio. As mentioned earlier, companies with high, low growth rate should trade at a premium discount compared to their peers. However, determining the amount of premium is likely to be subjective. Growth-adjusted price-to-earnings ratio, also called PEG ratio, overcomes this problem by factoring in the growth rate in its calculations. The PEG ratio is defined as growth-adjusted price-to-earnings ratio equals current price of stock divided by earnings per share divided by growth rate. PEG ratio was the term coined by Peter Lynch, a savvy investor and fund manager. He believed that sometimes a high price-to-earnings ratio could be justified on the foundation of high growth potential in the business. However, he also warned that high growth regime may not continue for a very long time and investors should be cautious of this fact. He stated that as long as PEG ratio is less than 1, business may be treated as undervalued. A stock with a PEG ratio greater than 1 is seen as overvalued. Although a benchmark based on the rule of thumb may not be appropriate in all circumstances, investors can compare PEG ratio of different companies to identify companies that are attractively priced compared to their competitors. For instance, a company A Limited, with earnings per share of 10 rupees, is trading at a price of 120 rupees, while another company, B Limited, with the same EPS is trading at price of 140 rupees. The P ratios of A Limited and B Limited work out to 12x and 14x respectively. Thus, based on the P ratio, it would appear that A Limited is a better investment compared to B. However, let us say A Limited is expected to grow at 10% per annum in the foreseeable future, while B Limited is expected to grow at 15% per annum. The PEG ratio for A Limited would be 1.2x, 12x divided by 10, while it is 0.93x, 14x divided by 15 for B Limited. Thus, when we factor in the growth rate, B Limited appears to be a better investment compared to A Limited. Enterprise value to EBITDA ratio. A business can be funded by various sources of capital, including common equity, preferred share capital, and debt. Since common equity has the residual interest, that is, they are entitled for whatever is left after paying all others, the rate of return earned on equity would also be affected by the current capital structure of the business. Thus, EPS and in turn ratios such as PE or PEG ratio are impacted by the capital structure of the business. While a retail investor may not have major say on the capital structure of the company, a controlling shareholder can alter the capital structure. Thus, from an acquirer's perspective, a valuation ratio that is neutral to the capital structure is likely to be more suitable. Thus, when a company is valued from the perspective of an acquirer or when it is a potential acquisition target, it would be more appropriate to value it based on enterprise value upon EBIT or enterprise value upon EBITDA ratios. Refer Section 3.1.7 for detailed discussion on enterprise value. Both the ratios are neutral to capital structure. However, in the case of capital-intensive industries, the difference in the historical cost of asset and choice of depreciation method can cause major discrepancies in the method of depreciation. Therefore, for such industries, it is preferable to use EV upon EBITDA. For other industries, EV upon EBIT is preferable. Similar to PE ratio, all else held constant, companies with lower ratio would be considered attractively valued compared to those with higher ratios. However, companies with higher growth potential or lesser risk are likely to attract a premium valuation. Enterprise value EV to sales ratio. P ratio EV upon EBITDA or EV upon EBIT ratio cannot be applied if the underlying profit metric is negative, that is loss. Further, in the case of companies that have recently managed to break even, the profit is likely to be much lower than their long-term potential. In such cases, the above multiples would be too high to be meaningful. In these cases, EV upon sales is likely to be a more meaningful metric as sales can never be negative. However, EV upon sales is suitable only in cases of companies that are likely to turn profitable and sustain such profitability in the future. If the company is loss-making and a turnaround is not likely in the foreseeable future, then the going concern nature of the company becomes doubtful. Therefore, those companies would have to be valued at liquidation value. Assets-based valuation matrices. The previous section looked at the comparison between what is paid and what is received in terms of earnings. In this section, assets will replace earnings and focus on the balance sheet variables to identify value in the business. Return on equity ROE and return on capital employed ROCE, as defined in previous chapters, are two important ratios in investment which are computed as follows. ROE equals net profits divided by equity capital or net worth. ROCE equals EBIT divided by total capital employed, debt plus net worth. ROE and ROCE indicate how well a business allocates its capital and what are the returns on the book values of equity and equity along with debt, respectively. However, you and me as investors are looking at return on our invested capital today and not essentially return on book values. Business is not available at book value today. Therefore, our concern is return on our invested capital, which is defined as return on invested capital equals earnings divided by invested capital. Let us address this point of return on our capital here. Price to book value ratio. Profit-based valuation ratio, such as PE or EV upon EBITDA, focuses on how much an investor has to invest to earn a unit of profit. Price-to-book value ratio, on the other hand, focuses on how much an investor needs to invest to gain ownership interest. It is calculated as follows. Price-to-book ratio equals market capitalization divided by balance sheet value of equity, or price-to-book ratio equals price per share divided by book value per share. Thus, this ratio measures how much an investor needs to invest to get ownership rights per unit of net assets of the company. The ratio is preferred more for valuing companies in the financial sector than in other sectors. This is on account of the reliability of the book value numbers. Since most of the assets of financial companies are monetary assets, the book value of assets more closely reflects their fair values. On the other hand, in the case of capital-intensive units, on account of the historical cost accounting, the balance sheet values often do not reflect the fair value. Further, in case of service sectors and technology firms, their important asset, including human capital and self-generated intellectual properties, do not find any place in the balance sheet. As accounting methodologies follow the principle of conservatism, book value of equity is often used to arrive at a conservative value of equity, even though the ratio may not be ideal to derive fair value for non-financial companies. Like most of the other ratios, all else held constant, companies with lower PB are considered attractively valued compared to companies with a higher ratio. However, companies with higher ROE should command a premium as the equity is more efficiently employed. Example. In the table above, AFB Finance is trading at 200 rupees per share while LKH Finance is trading at 175 rupees per share. How do we identify which of the two is an attractive buy using price-to-book value ratio? First, we need to calculate book value per share BVPS. For AFB Finance, BVPS is 198 rupees, that is, rupees 9,900 lakhs divided by 50 lakhs. Similarly, the BVPS for LKH Finance is 160 rupees. We can now calculate the price-to-book ratio for these two companies. 1.01, that is, 200 divided by 198 for AFB Finance, and 1.09, that is, 175 divided by 160 for LKH Finance. Thus, comparing price-to-book ratios alone and ignoring other factors, we arrive at a conclusion that AFB Finance is less expensive than LKH Finance. In practice, it is preferred to compare a company's multiple with the average multiple for the entire industry rather than against only one peer. Thus, all else held constant, we may conclude that companies with lower PB ratio compared to the industry's ratio are attractively valued. Enterprise value EV to capital employed ratio. Enterprise value includes the value of equity and debt of a firm and is defined as EV equals value of equity plus value of debt minus cash and cash equivalents. EV to capital employed ratio is defined as EV to capital employed ratio equals enterprise value divided by capital employed, total equity plus total debt. EV to capital employed ratio along with return on capital employed ratio can be used in combination to have a sense on return on our invested capital to facilitate investment decision-making. Consider a business with net worth is 100,000 rupees, debt on the balance sheet is 100,000 rupees, market capitalization is 500,000 rupees, cash and cash equivalents on the balance sheet are nil, and our OCE, EBIT divided by capital employed, is 45% per annum. Capital employed equals 100,000 plus 100,000 is equal to 200,000. EV equals 500,000 plus 100,000 is equal to 600,000. EV to capital employed ratio equals 600,000 divided by 200,000 is equal to 3. If our OCE is 45% and the investor is paying EV, which is 3 times of capital employed, the money would generate only 1/3 of this our OCE, that is 15%. 45% on 200,000 would amount to 15% on 600,000. The investment decision will depend upon whether this is an adequate return on capital invested. For example, if the investor wants a 20% minimum return on capital, in this example, the investor would not be willing to pay EV of more than 2.25 times 45 divided by 20 of employed capital in the business viz. 450,000 rupees. Net asset value approach. Net asset value, NAV, of equity is the market value of an entity's assets minus the value of its liabilities. This is different from the book value or net worth of equity, as one is using the market value of assets, not the book value of assets, to arrive at the NAV. Net asset value may represent the current value of the total equity, or it may be divided by the number of outstanding shares to compute net asset value per share. This valuation methodology is used in some businesses which are extremely asset-oriented, such as real estate, shipping, aviation, etc. Other metrics. In addition to the above, there are many valuation ratios that an analyst may employ depending upon the industry and the scenario. These include the following. Price to embedded value. This metric is specifically used in the case of life insurance business. Embedded value refers to the present value of the expected net future cash flow adjusted for probability of a life insurer from the policies that are currently in force. Embedded value is a critical metric for life insurers. Hence, analysts prefer to use this ratio. Price to adjusted book value. Adjusted book value, ABV, refers to fair value of assets minus fair value of its liabilities. As compared to book value, ABV factors in off-balance sheet items as well. This metric can be applied to value and BFCs. EV to capacity. In certain scenarios, the financial metrics of a company may not reflect its potential value. This is likely in the case of startups or companies that are currently undergoing special situations. Under such a scenario, it may be appropriate to use operating metrics in place of financial metrics. For example, a large steel plant currently out of operation can be valued based on its production capacity. A startup in e-commerce can be valued based on the number of users, number of transactions, or based on the value of transactions carried out on its website/mobile app. Relative valuations, trading and transaction multiples. Relative valuation is basically intuitive. We do this all the time in our personal lives. Here, we try to value an asset looking at how the market prices similar/comparable assets. The best example of this is pricing real estate. If you are looking to buy an apartment, you always find the price of comparative apartments in that locality, which kind of becomes your indicative value for negotiation purpose. This is highly useful and quick estimate of value with limited computations and assumptions. However, it reflects the current market mood, which may be quite optimistic or pessimistic. Therefore, it is always good to use parameters like maximum, minimum, average, etc. while using relative valuations. Practically, all the earnings and assets-based valuation parameters defined above can be looked at for each business historically for several years. One can also look at these parameters as comparison across the peers and/or industry ratios to build a sense whether something looks cheap or expensive. These comparables may be coming from the stock market called trading multiples or from the other similar transactions called transaction multiples. Sum of the parts, SOTP valuation. Several businesses operate as a cluster/bundle of businesses rather than one business. For example, ITC, L&T, and other corporations have different businesses under one umbrella. Best way to value these businesses is to value each business separately and then do the sum of those valuations. This method of valuing a company by parts and then adding them up is known as sum of parts, SOP valuation. Please note, for all practical purposes, each of the business verticals for these conglomerates would be treated as an independent business and valued as described above in this unit based on earnings and assets. And then simple summation can be used to arrive at the value of the total business. Other valuation parameters in New Age economy and businesses. Sometimes people wonder on valuations of the New Age businesses such as e-commerce companies or tech companies such as WhatsApp, Zomato, LinkedIn, Facebook, etc. Honestly speaking, it is difficult to put the numbers together to arrive at the valuations at which these transactions are happening. We may call it our own limitation to understand the value proposition. Without attempting to do this impossible task, let us state that in New Age economy, people use absolutely new parameters/language such as eyeballs, page reviews, footfall, ARPU, number of users, etc. to justify exorbitant valuations. Honestly speaking, as Buffett would state, all of these should ultimately translate into profits for owners at some point in time. If there is no visibility of that happening, most of these valuations would sustain till there is a storyline, people believe in those stories, and next buyer is available for the same, and would fall like a pack of cards in absence of those. We have seen that during the dot-com boom in 2000-2001. Capital asset pricing model. Capital asset pricing model has been discussed earlier in this chapter in section 10.5. Objectivity of valuations. So many computations for valuation result into a question: is valuation objective? This may appear so, but it is a very subjective exercise, as inputs required in various methods as defined above are quite subjective without any generally accepted standards. Further, valuation is not timeless, and it can change dramatically if circumstances of business change. To conclude, there is no precise estimate of value, and complicated quantitative models need not mean the valuation is precise. It only means a false impression of preciseness. Some important considerations in the context of business valuation. If earning power of a business is high, book value, BV of shares could be less important. But if earning power of business is low, BV becomes very important. As equity/share reflects part ownership in a business, to value share, we need to value entire business. EV and not the market capitalization is the true value of the firm for private owner. PE for a leveraged firm may be deceptive. Look at debt levels in the business. Look at the consolidated numbers and not just the standalone numbers. Focus on ROE and not EPS. EPS does not account for retained earnings. Leverage improves ROE, but excessive leverage is risky. Differentiate between ROCE and ROE. ROCE reflects the true return on capital. ROE could be manipulated by high leverage. ROCE and ROE should be closely knit. Any wide variation should trigger investigations.